I have been tracking tax code changes long enough to recognize when a window opens that will not open again. 2025 through 2028 represents that window, not because of what was promised, because of what was legislated. A series of provisions embedded in recent tax law has created a temporary structure that dramatically alters the tax landscape for retirees and near retirees. These provisions have expiration dates, and those expiration dates are not negotiable. They are written into the statute. After December 31st, 2028, the window closes, and the decisions you make between now and then will determine whether you pay tens of thousands of dollars more in taxes over the remainder of your retirement, or whether you use the structure that currently exists to minimize that burden permanently. Let me be precise about what has changed and what is temporary, because precision in tax planning is the difference between wealth preservation and wealth erosion. The Tax Cuts and Jobs Act of 2017 made substantial changes to individual income tax rates, deductions, and exemptions. Many of those changes were set to expire at the end of 2025. What recent legislation has done is extend certain provisions through 2028 while adding new temporary benefits specifically targeted at individuals over the age of 65. The result is a 4-year period during which the tax code is more favorable to retirees than it has been in decades, and more favorable than it is likely to be again in the foreseeable future. The standard deduction, which doubled under the 2017 law, remains elevated through 2028. For 2025, the standard deduction for a married couple filing jointly is approximately $29,700. That is the amount of income you can receive without owing any federal income tax, assuming you take the standard deduction and have no other adjustments. But here is what most people have not yet absorbed. The recent legislation added an additional deduction for taxpayers aged 65 and older. This is a temporary provision. It exists only for tax years 2025 through 2028. The additional deduction is $6,000 per person. If you are 65 or older, you get an additional $6,000 deduction. If you are married and both spouses are 65 or older, you get $12,000 in additional deductions. Now add those numbers together. A married couple, both over 65, filing jointly in 2025, has a combined standard deduction of approximately $41,700 before accounting for any other adjustments. That means this couple can have $41,700 in income and owe zero federal income tax. And if they have additional adjustments, such as contributions to health savings accounts or other above-the-line deductions, that threshold moves even higher. This is not speculation. This is the current structure of the tax code, and it exists for exactly 4 years. After 2028, the additional $6,000 deduction for seniors expires. The standard deduction itself is scheduled to revert to pre-2017 levels, adjusted for inflation. The lower tax brackets that currently apply are scheduled to increase. The result will be a significant increase in tax liability for retirees who have not taken action during this 4-year window. Now, let me explain why this window matters and what actions need to be taken during it. Most retirees have accumulated wealth in tax-deferred accounts, traditional IRAs, traditional 401ks. These accounts were funded with pre-tax dollars. You did not pay income tax on the money when it went in. You will pay income tax on the money when it comes out. And at age 73, you are required to begin taking distributions from these accounts, whether you need the money or not. Those distributions are called required minimum distributions, or RMDs, and they are calculated as a percentage of your account balance. The older you get, the higher the percentage. Here is the problem. If you have a large balance in tax-deferred accounts, your RMDs in your 70s and 80s can push you into higher tax brackets than you were ever in during your working years. You spent decades deferring taxes, and now you're forced to recognize large amounts of income at a time when your ability to control your tax situation is limited. The RMD is mandatory. You cannot choose not to take it. And if you do not take it, the penalty is 50% of the amount you were supposed to withdraw. The IRS does not give you the option to leave the money in the account indefinitely. This is where the current 4-year window becomes critical, because right now you have the ability to move money out of tax-deferred accounts at historically low tax rates, using the elevated standard deduction and the additional senior deduction to shield large portions of that income from tax. This strategy is called Roth conversion, and it is the single most powerful tax planning tool available to retirees during this period. Here's how it works. You take a distribution from your traditional IRA or 401k. That distribution is taxable income. But instead of spending it, you immediately deposit it into a Roth IRA. You pay the tax on the conversion in the year you do it. But once the money is in the Roth IRA, it grows tax-free. And when you withdraw it in the future, those withdrawals are completely tax-free. No income tax, no RMDs. The money is yours, permanently, without further tax consequences. The strategic advantage of doing this during 2025 through 2028 is that you can convert large amounts while staying within the 0% or very low tax brackets. Let me give you a concrete example. A married couple, both over 65, with $41,700 in standard and senior deductions, can convert $41,700 from a traditional IRA to a Roth IRA and owe zero federal income tax. If they have other income, such as Social Security or pension income, they can still convert enough to fill up the lower tax brackets before hitting the higher rates. And here is the compounding benefit. Every dollar you convert now is a dollar that will not be subject to RMDs later. Every dollar in a Roth IRA reduces your future tax-deferred account balance, which reduces your future RMDs, which keeps you in lower tax brackets throughout retirement. This creates a cascading effect, where early action produces benefits that multiply over time. But Roth conversions are only part of the strategy. The second opportunity during this window is tax gain harvesting. This is the inverse of tax loss harvesting, which most people are familiar with. Tax loss harvesting involves selling investments at a loss to offset gains. Tax gain harvesting involves selling investments at a gain deliberately in order to reset your cost basis while paying little or no tax on the gain. Here's why this matters. Long-term capital gains, gains on investments held for more than 1 year, are taxed at preferential rates. For most people, the rate is 15%. But for taxpayers in the lowest two income tax brackets, the long-term capital gains rate is 0%. That is not a typo. If your taxable income is below a certain threshold, you pay zero federal tax on long-term capital gains. For 2025, the threshold for married couples filing jointly is approximately $94,000 in taxable income. If your taxable income is below that amount, your long-term capital gains are taxed at 0%. And remember, taxable income is your total income minus your deductions. So a couple with the $41,700 deduction can have total income of $135,700 and still be within the 0% capital gains bracket. This creates an opportunity. If you have appreciated investments in taxable brokerage accounts, you can sell those investments, realize the gain, pay zero tax on the gain, and then immediately repurchase the same investments. This resets your cost basis to the current market value. In the future, when you sell those investments, your taxable gain will be calculated from the new, higher cost basis. You have effectively locked in tax-free growth up to the point of the sale. This strategy only works if you are in the 0% capital gains bracket. And the current tax structure, with its elevated standard deduction and additional senior deduction, makes it much easier to stay within that bracket during 2025 through 2028. After 2028, when deductions decrease and tax rates increase, far fewer people will qualify for the 0% rate. The window for tax gain harvesting will narrow significantly. The third strategy, and the one that requires the most precise planning, is income smoothing. This involves deliberately recognizing income in years when your tax rate is low in order to avoid recognizing large amounts of income in years when your tax rate would be high. The goal is to flatten your income over time so that you never spike into the highest brackets. Income smoothing requires coordination across multiple income sources: Social Security benefits, pension payments, IRA distributions, Roth conversions, capital gains. Each of these can be timed and sized to keep your total taxable income within the most favorable brackets. The 4-year window from 2025 through 2028 is ideal for this strategy because the brackets are wider and the deductions are higher. You have more room to maneuver before you hit the thresholds that trigger higher rates or additional Medicare premiums. And Medicare premiums are a critical part of this equation. Most people do not realize that Medicare Part B and Part D premiums are income-based. If your modified adjusted gross income exceeds certain thresholds, you pay higher premiums. These are called income-related monthly adjustment amounts, or IRMAAs. The thresholds are relatively low. For 2025, a married couple with modified adjusted gross income above $206,000 begins paying higher Medicare premiums. And the increases are substantial. The highest IRMA tier can add several $1,000s per year to your Medicare costs. Every dollar of IRA distribution, every dollar of capital gain, every dollar of taxable income pushes you closer to those thresholds. And once you cross them, the additional cost is immediate. This is why Roth conversions and tax gain harvesting during the low tax window are so valuable. By recognizing income now, at lower rates, and with higher deductions, you reduce the income you will be forced to recognize later, when RMDs kick in and when IRMA thresholds become much harder to avoid. There's also the issue of Social Security taxation. Up to 85% of your Social Security benefits can be taxable, depending on your other income. The formula is complex, but the basic principle is straightforward. The more income you have from other sources, the more of your Social Security becomes taxable. If you have large RMDs in your 70s and 80s, you will be paying tax on a larger portion of your Social Security benefits. But if you reduce your future RMDs by doing Roth conversions now, you reduce the amount of Social Security that becomes taxable later. This is another cascading benefit that compounds over time. Now, I want to be careful about what I am stating and what I am implying. These strategies are not appropriate for everyone. They depend on your specific circumstances, your current tax bracket, your expected future tax bracket, the size of your tax-deferred accounts, the composition of your other assets, your health and life expectancy, your legacy goals. All of these factors must be considered. But the underlying structure is clear. The tax code as it exists from 2025 through 2028 is more favorable to retirees than it has been in recent history and more favorable than it is scheduled to be after 2028. The window is open. It is open for exactly 4 years, and the decisions you make during those 4 years will have consequences that extend for decades. If you do nothing, you will pay more in taxes, not because the law changed in a way that targeted you, but because you failed to use the structure that was temporarily available. The RMDs will come. The tax brackets will narrow. The deductions will shrink. And the opportunity to have acted when the conditions were favorable will be gone. This is not a prediction. This is the current trajectory based on legislation that has already been enacted. The sunset provisions are written into the law. Unless Congress acts to extend them again, which is possible but not certain, the provisions expire. And when they expire, the tax environment reverts to a less favorable structure. The retirees who will fare best over the next 20 to 30 years are the ones who recognize this window for what it is and take action during it. Roth conversions to reduce future RMDs, tax gain harvesting to reset cost basis at 0% rates, income smoothing to avoid IRMA surcharges and Social Security taxation spikes. These are not speculative strategies. These are applications of the current tax code to achieve outcomes that the code, as currently written, permits. The 4-year window is not a metaphor. It is a legislated timeline. It began in 2025. It ends in 2028. What you do during that window will determine your tax burden for the rest of your retirement. And the rest of your retirement does not wait for you to figure out what changed.